1. Private equity in 401k, high reward or high risk. 2. White House to allow private equity in 401k. What does it mean for your retirement savings? 3. Trump's executive order, 401k, to invest in private equity. 1. Private equity in 401k, high reward or high risk. Picture this, the exclusive playground of billionaires and institutions might soon become part of your retirement savings strategy, but is this golden ticket actually a trapdoor? For decades, private equity investments were reserved for ultra-wealthy individuals, university endowments, and massive pension funds. That walled garden is cracking open. Now, ordinary workers with 401k plans are gaining access to private markets, investments in companies not listed on public stock exchanges. Retirement giants are leading this charge. BlackRock, the planet's largest asset manager, revealed plans last June for a 401k target date fund including private investments, launching in 2026. Not to be outdone, Empower announced in May it would bring private options to workplace retirement accounts this very year. Other providers are making similar moves. Voya Financial recently partnered with Blue Owl Capital for this purpose. And here's the political accelerant. Sources indicate the Trump administration may soon sign an executive order urging federal guidelines to ease private investments into 401k, as reported by the Wall Street Journal. Why this aggressive push? Private equity firms, which pool capital to buy, overhaul, and sell companies, along with private credit lenders, who finance businesses outside traditional banks, are eyeing the colossal $12 trillion defined contribution retirement market. But here's where it gets controversial. While wealthy investors historically enjoyed private equity's potential rewards, everyday savers were locked out. Why? Minimum investments often hit 7 figures, and your money could be frozen for years. So why do the rich love it? Returns. Over the past 2 decades, private equity outperformed public stocks by 1 to 2 percentage points annually, averaging 10.5% from 2000 to 2020. Some estimates run even higher. It offers the highest upside, explains Keith Singer, a Florida financial planner. But this isn't a smooth ride to profits. Private companies operate with minimal regulatory oversight, meaning sketchier financial visibility. Transparency shrinks when companies stay private to dodge public filing requirements, notes Robert Brokamp of The Motley Fool. Publicly traded companies have halved since the 1990s, leaving retirement savers eyeing murkier waters. Now, brace for the risk reality check. Public stocks carry volatility, but an S&P 500 index fund still holds established giants. Private equity? It often resuscitates distressed businesses. Bankruptcies run higher here, and Investopedia's Caleb Silver flags it as riskier and more speculative. His stern advice? Never allocate over 10% of your portfolio to private investments. But here's the twist, new 401k products aim to tame these risks. BlackRock's fund caps private exposure at 5-20%, shrinking as you near retirement, and wraps it in target date funds holding liquid public assets. Since these funds trade daily, the notorious illiquidity of private equity becomes less daunting. The regulatory landscape shifted in 2020 when a Trump-era letter clarified that 401k plans could include private equity without breaking federal rules, provided managers prioritize savers' best interests. But controversy erupts here. Critics like Senator Elizabeth Warren warn that hidden fees, opacity, and unsubstantiated returns could jeopardize retirement security. In a fiery letter to Empower CEO, she demanded safeguards for billions in worker savings. Empower shot back, championing democratization of private markets after decades of exclusion. CEO Edmund Murphy III insists everyday savers deserve access to lucrative alternatives. And this is the part most people miss. Industry leaders hint this revolution needs legislative or executive muscle to truly accelerate. Providers will feel more comfortable if Congress explicitly greenlights it, says Thomas Gahan of Procyon Partners. He views current offerings as stepping stones toward potentially broader access, like standalone private investment funds within 401(k)s. But expect evolution, not revolution, this will unfold over years, not days, Gahan cautions. So, we're left with a burning question, with potential for higher returns but real risks of instability and opacity. Should private equity become a standard option in your retirement plan, or is this a gamble that could backfire spectacularly? What side are you on? Share your take in the comments. 2. White House to allow private equity in 401(k)s. What does it mean for your retirement savings? Imagine a shift in how American retirement savings are managed. This is where the story gets intriguing. The White House is currently working on an executive order that could open the door for 401(k) accounts to include investments in private equity. This move has the potential to significantly change the investment landscape for millions of Americans saving for retirement. While the final details are still being fine-tuned, and no official announcement date has been set, sources familiar with the situation indicate that President Donald Trump might sign the order shortly. The insiders requested anonymity, as these discussions are still confidential. The industry, which has long sought greater access to the enormous pool of retirement funds, roughly $12.5 trillion held in 401(k)s, is likely to view this as a momentous victory. But here's where it gets controversial. Allowing 401(k) plans to invest in private equity could bring both huge opportunities and significant risks. Supporters argue that it offers a chance for higher returns and diversification, advantages that could benefit everyday investors. Critics, however, warn of increased volatility and the potential for losses, especially for those who might not fully understand the complexities involved. And this is the part most people might overlook. Such a policy shift could reshape not just retirement strategies but the entire financial industry's approach to investment products. Would opening up to private equity truly benefit the typical worker, or could this expose them to unforeseen dangers? This debate is bound to spark strong opinions. Do you think expanding access to private markets is a smart move, or does it cross a line into risky territory? Share your thoughts below. This is definitely a development worth watching. 3. Trump's executive order, 401(k)s to invest in private equity. Imagine a significant shift in the world of retirement savings where your 401(k) could potentially invest in private equity, offering a new avenue for growth. But here's where it gets controversial. The Trump administration is reportedly finalizing an executive order that would pave the way for this very change. President Donald Trump is expected to sign this directive soon, although the exact timing remains uncertain as discussions are still ongoing. According to the Wall Street Journal, this move could be a game-changer for the private equity industry, which has been pushing for access to the approximately $12.5 trillion held in 401(k) accounts. This proposed regulation represents the most aggressive step taken by the Trump administration to incorporate private equity into retirement plans. For years, top officials in Washington have grappled with how to address the legal hurdles that have typically barred alternative assets like private equity from most defined contribution plans. Traditionally, retirement portfolios have been heavily weighted towards stocks and bonds due to the wariness of plan administrators about investing in illiquid and complex financial instruments that come with higher risks. The upcoming directive would extend previous actions taken during Trump's first term, including Department of Labor guidelines that stated plan administrators would not breach their fiduciary duties by including private equity in their portfolios. However, these guidelines were later rescinded by the Biden administration. Both alternative and traditional asset managers are keen on gaining a presence in the defined contribution market, seeing it as a substantial growth area. As large institutional investors like U.S. pension funds and endowments find themselves constrained in their private equity investments, they are turning their attention to the 401(k) sector amidst a broader slowdown in deal activity and reduced client payouts. Supporters of this change argue that allowing 401(k) plans to invest in private markets would offer savers a wider array of investment options and potentially higher long-term returns. Yet, the higher risks and hefty fees associated with private equity investments have sparked concerns. Critics fear that plan administrators might face increased legal liabilities if these investments underperform or if fees erode retirement savings. Financial experts are urging policymakers to recognize that retirement portfolios are becoming misaligned with the current financial landscape. They note the steep decline in the number of publicly traded U.S. companies since the 1990s alongside a dramatic increase in private equity assets, which more than doubled over the past decade. With fewer opportunities available in public markets, advocates believe that many investment chances are now found in the private sphere. By enabling 401k plans to invest in private equity, proponents argue, ordinary savers could gain access to opportunities that have historically been exclusive to institutional investors. Expanding access to alternative investments in 401k retirement plans will provide more Americans with the diversification and investment options needed to build wealth and achieve a successful retirement, stated Brian Corbett, President and CEO of the Managed Funds Association, a trade group representing the alternative asset management industry. We look forward to collaborating with the Trump administration to develop an approach that safeguards investors while empowering retirement plan sponsors to confidently offer alternative investment options with various liquidity levels, aligning with long-term retirement objectives, Corbett added. This proposal raises important questions. Is expanding 401k investment options to include private equity a sensible move, or does it pose undue risks to individual savers? What do you think? Share your views in the comments.